should you pay for your life insurance using your corporation, or should you pay for your life insurance personally? Well, the first thing to consider is the different tax rates between a corporation and the personal marginal tax rate system. So in Ontario, a CCPC is taxed at 12.2% on any income below $500,000. It's also taxed at 26.5% on any income above $500,000. When comparing this to the personal marginal tax rate system, right now the highest tax bracket is 53.53%, and this is on the personal side. So if someone was going to invest into a whole life insurance policy, and let's say the premiums were $100,000 every single year, and they were deciding on where is it better to pay for? Should the corporation pay for it, or should they pay for it personally? Looking at the corporation, the first thing to note about any corporately paid for life insurance policy is it's paid with after-tax dollars, which means the life insurance premiums are not tax deductible. You have to factor in the tax above that $100,000 based on whatever tax bracket you're in. So let's assume this individual is in the 26.5% corporate tax bracket. That means they would have to earn $136,054 to pay $36,054 in tax to net that $100,000 for the policy. So the total cost of a $100,000 policy in a corporation at the 26.5% tax bracket is $136,054. Now, factoring this into the personal side of things, you'd have to earn $215,192 to pay $115,192 in tax to have that same $100,000 left over to pay for the policy. So as you can see, it costs you significantly more from a gross perspective personally than it does corporately. That's a difference of just over $79,000 for the same policy. So every single year, this individual is technically paying almost $80,000 more per year for the same $100,000 policy. And let's say you paid for 20 years, that could be nearly $1.6 million in kind of wasted money because of poor planning, because this individual is paying for a policy personally versus paying for it corporately. Now, one thing to consider when you're paying for a corporately owned policy is to determine if you're ever going to sell your company. And if you are, it might be more advisable to have the policy in a holding company. So that way, when you do sell the OpCo, that company goes with the sale and you keep the holdco for the rest of your life and keep the policy in there. Now, for a corporately owned policy, the corporation will be the owner, the corporation will be the payer, and the corporation would also be the beneficiary. So when the business owner or life insured passes away, the life insurance company will pay the death benefit tax-free into the corporation, and the corporation's capital dividend account will get a credit. And what this credit means is whatever the credit is, you're able to pull assets out of the corporation tax-free. So if the business owner lives to life expectancy, all of the life insurance would be able to come out on a tax-free basis. So when comparing the difference between paying for a policy personally and corporately, as you can see, it's a very, very significant difference in the actual total cost of it. So please just be aware to make sure you're not wasting quite a bit of money if you're someone with a holdco or corporation that can pay for a policy. Thanks for watching.